Will the Singapore property market crash?
With the U.S. recent announcement of new tariffs, the global stock market has taken a hit. Naturally, many buyers are now wondering, will our property market crash too? In this video, we will do a deep dive into this topic. Historically, Singapore's property market had a strong correlation with both global and local stock markets. You could see this clearly during the 1997 Asian financial crisis and the 2008 subprime mortgage crisis. The Singapore Property Price Index plunged in tandem with the stock market. However, fast forward to the COVID-19 pandemic, arguably the worst global disaster since World War II. Stock markets crashed, supply chains broke down, the world came to a halt, but yet, surprisingly, Singapore's property market remained largely unaffected. So, what changed? Why did Singapore's property market decouple from global chaos? And can it hold up again? The key lies in the cooling measures introduced by the Singapore government. Firstly, financial prudence and strong buyers. Singapore enforces strict borrowing rules. You can only borrow up to 75% of a property's value, and under the total debt servicing ratio TDSR, your monthly loan repayments can't exceed 55% of your income. This translates to higher down payments, lower leverage, and most importantly, buyers are borrowing within their means. Combined with one of the highest savings rates in the world, Singapore buyers have strong holding power. That's why fire sales are rare today, unlike the past. Secondly, the introduction of additional buyer's stamp duty ABSD plays a key role in preventing oversupply. In the past, or in many other countries, wealthy individuals often purchased multiple properties. During a crisis, they could offload several units at once, flooding the market and triggering sharp price corrections. But in Singapore, ABSD changes that dynamic. Most people own just one or two properties, primarily for their own stay. Even those who own more are unlikely to sell, choosing to hold on to their properties, as selling would mean facing significant ABSD costs if they ever want to buy back. This creates a stickier market with lower volatility. Lastly, reduced speculation as short-term flipping is no longer attractive thanks to seller's stamp duty SSD, which applies for up to 3 years. Also, unlike the stock market, the property market isn't subject to short selling or large-scale institutional manipulation. Most transactions today are from genuine homeowners or long-term investors focused on long-term growth. These measures keep the market steady. However, what pushes it forward? Let's look at 3 long-term growth drivers. Firstly, population growth continues steadily, averaging around 100,000 per year, and we're on track to reach the 6.9 million mark. Secondly, income levels are rising, with the higher income segments showing the fastest growth. Lastly, property isn't just a vehicle for capital appreciation, it's also a reliable hedge against inflation and a strong form of asset protection. By putting our money in real estate, we're able to outpace inflation and sustain, or even enhance, our standard of living over time. Singapore's property market has largely decoupled from the stock market, thanks to strong safeguards put in place through government cooling measures. And with every crisis comes opportunity. Stay sharp, stay informed. Subscribe to Property Sensei for clarity in a noisy market.